Hello, I'm Bernard Hickey with the Daily Briefing from interest.co.nz. Today we'll look at the latest signs of a slowing property market and some ominous signals coming out of Auckland in particular. We'll dig behind Kiwibank's announcement on Monday that it has hiked its one-year term deposit rate special to 9%. And finally we'll find out more about a rare thing, a finance company coming out of receivership. We start with news on house prices, both in Auckland and nationally. Firstly, the freshest data from the biggest market and the biggest real estate agent in that market. Barfoot and Thompson has reported its sales volumes fell 40% to 603 in January, and prices fell 7.5% in that 1 month from December to January. Barfoot and Thompson are not yet ready to predict a crash in the market. They're real estate agents after all, but the signs don't look good. Remember, Barfoot and Thompson are responsible for handling about 40% of the house sales in Auckland, and Auckland is the leading indicator for house prices nationally. Speaking of national house prices, we received the quotable value survey of house prices nationally on Monday. It showed house price growth in the 3 months to January slowed to 8.9% from a year ago. That annual growth rate is down from 10% in the 3 months to December. But the ominous sign was in the commentary from Quotable Value, because they see a lot more of the detail behind each sale. They warned they are starting to see mortgagee sales. This will be one of those canaries in the mine that show the housing market is in trouble. This is one of the key signs of stress in the US market right now, where prices have fallen sharply in the last year. Now some news on the term deposit front. Kiwibank has increased its one-year special term deposit rate to 9% from 8.8%. Now this ups the ante in Kiwibank's battle with the big four banks for share in that term deposit market. It also makes life even more uncomfortable for finance companies trying to attract some money. This special rate is for a term deposit where interest on the term deposit is paid on maturity. This move officially makes Kiwibank the best bank in this category. You can find a full comparison of one-year term deposit rates on interest.co.nz. It shows Kiwibank has jumped ahead of its rivals in this particular niche in the market for term deposits that pay out on maturity. ANZ and National special rate is 8.75%, BNZ is right out of the market at 7.9%, while ASB is the best of the rest at 8.8%. Westpac is at 8.5%. A move to 9% by Kiwibank will also put finance companies under increasing pressure, given that many have their rates sandwiched between 9% and the psychologically key 10% level. That's because many finance companies are reluctant to push their rates over 10% for fear of appearing risky. Now, as the chart we're showing here mentions, the average rate advantage for finance companies is around 87 basis points right now. That's near its lows over the last 5 years and is well below the 200 plus basis points it stood at before the bulk of the finance company boom started in 2003 and the bust started in 2006. You would have thought the collapse of 14 finance companies since May 2006 would have blown that rate differential out over 300 basis points. Instead, it's at 87 basis points. But finance companies are now starting to realise they will simply have to offer higher rates to get depositors' money. Hanover Finance increased its main rates on Friday. Hanover lifted its 2-year debenture rate from more than $5,000 to 10.4% from 9.9%. And now for a piece of rare news. Late on Friday, we had a finance company announce it had clawed its way out of receivership. The Christchurch-based Property Finance Securities announced it had found the cash it needed from shareholders to carry through on a plan to get out of receivership. Property Finance Securities is listed through its parent on the NZX. The chief executive of Property Finance, Daryl Queen, told interest.co.nz the plan is now to run down the book of first mortgages on residential and investment properties and pay out the proceeds to debenture holders. Property Finance owes $79.5 million to almost 3,000 investors holding debentures. Queen said Property Finance aims to pay back $15 million of the capital in the first year, $15 million in the second year, and the rest in the third year. The interest will be compounded and be paid out after all the capital has been refunded. Queen says he expects the first payment will be made to investors midway through next week. A rare occurrence, although others, including Geneva Finance, are hoping they can dig themselves out too. I'm Bernard Hickey from interest.co.nz with the Daily Briefing. Catch you on Tuesday.